Okay, I think we should go ahead and get started. My name is Matt Friedman. I'm the CEO of the Mekong Club, and today's seminar is entitled How to Amplify the S in ESG. Prior to kind of introducing our panel and getting started, I'm just going to say a few opening words to set the scene. And to begin with, I'd like to talk a little bit about my own history related to ESG. You know, I came from the government sector, the NGO sector, the donor sector. And when it comes to topics like ESG, I didn't hear about this terminology until 2016. I was in Canada and I was doing a road trip and I was in front of a bunch of teachers. And after doing a presentation on the role of the private sector in modern slavery, I had a number of teachers come up to me and say, well, how do we know that the retirement funds and investment funds that we have are not being tainted by modern slavery? I didn't have an answer to that. And as a result of that, I went back and talked to some of my colleagues here in Hong Kong, and they told us all about this concept of ESG and what it was and so forth. And so we began to delve into it because as an organization that works with the corporate sector, we thought it was really important to know about this. Sure enough, after a while, we had gained enough experience to find ourselves on panels. And so for a couple of years, this was around 2017, 2018, we found ourselves, you know, with several panelists talking about the S as it relates to ESG. And it almost felt like deja vu because it was almost the same panel over and over again. We were talking about when the S would be articulated and how it would have indicators related to modern slavery. But it just didn't feel like it was moving forward. It was something that was always kind of out there in the future. And so our organization got a little bit impatient and decided that we were going to do something on this. So we hired a person. We invested in understanding the ESG and the S and how it related to modern slavery, developed a whole bunch of indicators and so forth. But that was pretty much just focusing on modern slavery, and many of the other indices and indicators related to the S were kind of ignored until July of last year, when a number of organizations came together. Reuters and Refinitiv brought us together to sit down and to debate and discuss and talk about the S and its relationship to ESG. And as a result of that, the outcome of that process will be articulated today in this webinar. So there is progress and things are moving forward. But before we get into kind of that progress, I just want to kind of reiterate as an activist the importance of ESG. You know, ESG is, you know, it's an official terminology. It, you know, it has that corporate feel to it, environmental, social, and governance. But what it really is about the interface between the private sector and the real world as it relates to the planet, as it relates to people, as it relates to communities. What we're talking about here is allowing us to kind of look at the measurement of corporates and business activities related to how it affects the world. So if companies take this seriously, and many of them are, the world is going to become a better place. And in fact, we've already seen that when it comes to the environmental side of things. We have very sophisticated indicators. They've been around for a while. They're measuring the carbon footprint and many other things. And as a result, positive changes are taking place. We see it in governance because the world expects that companies need to be governed in a way that sustainability is given precedence, and decisions are made in such a way that companies are able to articulate what they're doing to do the right thing. On the S side, even though we don't have kind of a clear sense of what the S is, the private sector is already very much involved in helping to address modern slavery. This is one aspect of the S. For example, banks are identifying what are called typologies that break down the criminal activity into component parts. Along the way, they identify where the transactions are taking place, which transactions could be perceived as associated with organized crime, and then they're using those transaction red flags against big data to determine if there are issues and problems. And they're finding them, and they're able to shut these businesses down by working with law enforcement. On the supply chain side, you've had companies that have been monitoring and auditing companies for years. I was in China in the early 1990s, and When I looked at factories then versus 30 years later, you see a huge difference. And it's because companies have gone in, audited, improved, made things better. And so the private sector has already been heroic when it comes to addressing many of these things. They just haven't really gotten credit for it. And so by using metrics related to ESG, we're able to allow for them to articulate the things that they're doing and the difference it's made. The last thing I want to mention is that there's this whole kind of new terminology related to what we call the new normal. You know, and a lot of it is related to the pandemic, but it also was starting prior to that. And so we're expecting to see major paradigm changes. And probably the biggest paradigm change we're seeing is that in the past, businesses would have as their purpose profit, prestige, and growth. But another thing has been added to that, and that's a business with purpose. We can no longer kind of anticipate that companies can just get away with those first three elements without including business with purpose, because what COVID and some of the trends that have followed have identified is that people do care about what companies do. They care about whether companies care about the planet, about communities, about people, are doing the right things. And that's kind of ingrained in this new normal that we're talking about. So as a result of that process, it's really important that the S in ESG get brought up to where the E and the G is, so that we have convergence across all of those, and then we can kind of get on with it, so that these metrics can be standardized, they can be used by investment companies and consumers to know where the companies that are really stepping up and doing the right thing are, so that we can make decisions based on that. So with that, I'm going to end. Thank you very much, and I'll hand it over to the panel.
Thank you, Matt. That was fantastic. It explains exactly what we've been up to since last summer, when Thomson Reuters Foundation and Julia, one of our speakers today, brought this working group together. And just to explain, the working group actually has EcoAge as one of the key partners, also 𝗓𝗃𝗃𝗃𝗃𝗃, a global law firm, Refinitiv, which is part now of the London Stock Exchange Group, and also us. So I'm the CEO of ISFC, which stands for International Sustainable Finance Center, headquartered who tried to do the global consultation and create the paper in the end. So welcome everybody. Thank you so much for joining us today. We have quite an exciting panel prepared for you. As you've all heard from your work, the ESG debate is really heating up. There's a lot of controversy around it. People are trying to figure out, what does actually good ESG approach or practice look like? It's not as easy as it might seem, because I'm sure a lot of you have also seen how many articles there are about, well, this is an alphabet soup, we have so many problems with data. However, as Matt nicely highlighted, things are moving. Private sector, investors, everybody's trying to figure out what's happening, and also trying to improve these approaches and moving the discussion forward, so that we actually have much more clarity about indicators. We have data that's comparable, data that's much more meaningful and reliable. And that is not an easy process. It will also not take a few days. It might take us still a couple of years or more, but I think the journey has started, and we see our paper that I have put it in the chat box that you can access on the Mekong Club's and Thomson Reuters Foundation's websites. We see this as a little bit of a creation of a discussion, as one of the most important steps to energize people to do something. So today we are joined by, we'll start with 𝗓𝗃𝗃𝗃𝗃𝗃𝗃𝗃𝗃𝗃𝗃, who's joining us from Refinitiv. She is the global head of ESG at Refinitiv. She joined Refinitiv from Thomson Reuters. She has been responsible for a lot of different things at Thomson Reuters, including end-to-end management of ESG, business, products, services. She's a proper expert in the ESG space. She's also part of the EU Technical Expert Group on Sustainable Finance. So she's very plugged into the current discussions. And prior to joining Thomson Reuters, she actually spent some time working at Morgan Stanley as well. So welcome, Elena. Thank you for joining us. Next, we also have Adam Harper, who is joining us from Hong Kong. He's the founder and CEO of Ashbury Communications. He launched the company in January 2020, so quite an interesting time to launch anything, as I found out during the COVID pandemic. He was previously with HSBC, Head of Communications for Greater China, so extremely interesting responsibility. He's also spent some time in journalism, so he has seen the world from many different seats. He started with Euromoney, institutional investor in London, and has worked across the globe and is an alumni of University of Cambridge. And last but not least, we have 𝗔𝗺𝗽𝗶𝗳𝗆 Rinaldi, the Director of Inclusive Economies at the Thomson Reuters Foundation. She joined Thomson Reuters Foundation in 2018, initially working as head of programs for trust law, which is a fantastic initiative where the foundation creates a global pro bono connection service. She's very passionate about inclusiveness and women's empowerment, and has a fantastic overview of essentially what is happening on gender and what is happening with different initiatives across the globe, working on ending modern slavery and a variety of addressing social issues. Also, I would suggest everybody checks out the Trust conference that Thomson Reuters Foundation hosts every year. It is a fantastic, one of the most engaging, interesting conferences I have attended that looks at a variety of social issues with some of the world's leading speakers. So without much further delay, I actually would like to ask some questions to 𝗔𝗺𝗽𝗃, because 𝗔𝗺𝗽 has been part of this process of creating this paper, doing the consultation, actually conceptualizing the whole project. So can you tell us why now, why this project, and what were actually the kind of key findings that came out of this nearly a year-long process of talking to people, doing research, and trying to figure out what does the S stand for in ESG? Please, 𝗔𝗺𝗽. You're muted.
Yes, of course. That's what I do all the time. But thank you for the great introduction. I'm so thrilled to be here with Adam, Elena, Matt, and yourself. And why this? So clearly there's a geopolitical reason, that a political reason or a social reason that Matt explained very well. So with COVID happening, it felt labor rights and social issues were just put at the front of the news. But we were thinking this even prior to the COVID pandemic and Black Lives Matter. The Thomson Reuters work to advance media freedom, foster inclusive economy, and promote human rights. And for a number of years, we really focused on extreme inequality and this exclusion of people in participating in the economy. We've been using our journalism, media development, legal research, and convening to combat modern slavery. And then lately, we're also looking at fostering fair and sustainable economic system and raising an awareness of the impact of technology on society. So in 2020, we're like, okay, we're focused on modern slavery, which is a horrible abuse of power and a human rights issue that needs to be addressed. But it's also the reason, it's almost like, what is the cause? Why is modern slavery happening? And a core of it is labor rights and exploitation. So we thought to start looking at the S in ESG to really then use our services to push for the impact portions of the S. And we noticed the S was lagging behind the E and the G on ESG. And so we actually started talking to Refinitiv, and they were doing a lot of things on data and on ESG in general, but also specifically we're interested on the S. They've done fantastic work on modern slavery as well. And so we gathered together a group of experts from very different backgrounds. So it's a bit eclectic. So we have Refinitiv, we have yourself, we have ISFC, we have Mekong Club, but we also have PRI, the Robert Kennedy of Human Rights, and 𝗂𝘃𝗁𝗂𝗁𝗂 to try really come together and look at how can we widen the adoption of the S criteria for investor and asset manager using data. And also looking at what indicator looked more at impact and not only just effort. So we decided to take the approach of busting 5 myths around the availability of data of the S, and then looking at realities and action, so that this paper could help investor and asset managers saying, okay, there are some myths. What is actually the reality, and how can I take first steps? And so I'll go quickly through the 5 myths. So first is around financial materiality. And what we found is that social performance was considered less material than environmental performance. But the reality that we found is that social issues are a key risk. And there's new legislation coming and that will make it a material risk for investors. And that investors should act now to get ready for the legislation coming around the world, and fulfill also their fiduciary duty of around human rights. The second is the starting point. A lot of people, because it's difficult, and I have to say, like, for a year from when I started, I realized it's much more difficult than I thought. So I will take, the group doesn't want to simplify. It is a difficult matter because it addresses a lot of different human rights and social issues, but the too difficult is used as an excuse to not start addressing it. While what we have found is that the reality that the link of between business and human rights and social performance in business is really well established now. And so people, the investors and company can really start using existing resources that have been developed to grapple and understand the complexity and how they want to address it. The other method that the S indicators are too hard to measure. And again, I want to emphasize that we know that it's hard, but we do think that there is data out there, it is available, and it's necessary that we start using it. And we can use, we mapped it out across, we came out with some indicators that we felt, and then mapped it out with GRI, SASB, Refinitiv, Rep Risk, and SDGs. And you can see there's a lot of available data where you can start. And Elena can give more details on that. And also is a role of the investor to demand more data, work with the data provider to get better data and more data. Fourthly, is like integration process. And a lot on the assets, qualitative surveys are preferred. And qualitative surveys play a very important role, but mixing quality and quantity is key to address the key issues. And then, so that's what we advise. Use a combination of the two to look at your diligence and engagement with corporate, and engage. That's what we've heard from a lot of our consultation. And lastly is, a lot is in the S is part of impact investing. We don't need to tackle that. But actually, the reality is that integration of the S is also a business opportunity. It not only mitigates your risk, but it's also a business opportunity. We've seen a lot of cases, an example you can see in the paper, where investing in the S has financial return, whether it's on diversity or B Corp, they're growing, I think 28% more than the average corporate company around the world. And so I think it's not only good for your risk, but a business opportunity, and more can be explored on that, and more is being explored. So our main takeaways here are these 5 myths that we identified are preventing resources from being allocated to improving the current approaches to assess social performance. So we need to break those myths and start addressing and improving, continue improving. Social issues are salient to all investors and beneficiaries. And the integration of ESG criteria leads to improved return, less volatility, and lower downside risk. Data on social use is available, and it's possible to increase the use of social indicators. And as I said, qualitative and quantitative can be mixed. And lastly, as a group, we believe that this is just a start. And so more resources need to be invested to standardize the S and shift corporate behavior. But we wanted to start the conversation and amplify and put the S in the core of the conversation. Sorry, Linda.
Okay, thank you so much, Julia, for doing a bird's eye view of what the main myths were and also what we discovered during our very intense, nearly year-long work. So Adam, bearing in mind that you have both reported on these issues for a while and now you are working in communications about these, we would love to hear actually whether this is something that you found as well. Are these real myths? Is there a bit of misconception of what's happening? And why do you think that's happening and how we can more effectively address it? Of course, one thing is engaging in conversation, but how do we get to those people who are very difficult to engage in conversations so that we don't end up preaching to the converted? So
thank you, Linda. Thank you. Yeah, it's great to be here. I'm a kind of interloper to this group. I wasn't involved with the white paper, but I'm an admirer of it and very grateful for the opportunity to join this discussion today. I found this paper very thought-provoking, very comprehensive. I think it's a really important step forward in the ESG process, or the process of ESG integration for investors. We're a small strategic communications consultancy. We work with financial institutions of all types with a focus on Asia. And I think for the kind of clients that we work with, you know, there are perceptions about S and the place of S and a social. And I think, you know, you are right in this paper to expose those myths. I think it's very important that that is done and to show that tools exist. I found what Julia said very interesting about the kind of next step from here being standardization. I do think it's clear to a lot of market participants that there is a lot of data out there about social factors as there is about the other factors or the other components of ESG. I think the challenge for a lot of financial institutions, though, is about standardizing and developing normative goals when it comes to the social component. This is very clear in the environmental climate world. You know, we have the target of the Paris Agreement. We're aspiring to a 1.5 degree scenario. I think it's a little bit harder, a little bit more complex in the social dimension. A few months ago, or actually over for quite a number of months, we worked with Matt at the Mekong Club on developing a paper about a goal for ending modern slavery in corporate supply chains, private sector corporate supply chains by 2030. And I think that's a good example of a goal that can focus attention and drive efforts in the same way that the climate change goals do. But it is a lot more complex in the social world. And this is, you know, feedback that we get a lot from the organizations that we work with. You know, if you look at a region like Asia, for example, you know, I know you highlighted in the paper as key themes, socioeconomic inequality and diversity and inclusion. Now, in a region as complex as Asia, how do you apply a normative standard when it comes to those themes across this region? What would it be? Who would define it? You know, these are very complex and rather subjective questions. And so I think that the challenge here is you've got to recognize some differences, but, and this is what people that I talk to are kind of thinking about, you have to recognize these differences. On the other hand, standards can't become so relativized that they're not standards at all. And I think really the challenge going forward from here that I see and that I hear about is, you know, giving financial institutions some kind of equivalent that they can, some kind of equivalent to climate scenarios that they can align their portfolio with, you know, over time, so that they can say, when we allocate capital and we think about this through a social lens, this is the goal that we're trying to achieve, and we direct our activities towards that.
Thank you, Adam. That's a very good, standpoint from where you sit. I think it's very interesting to hear about the communications space anyway, and from having had such an interesting life story as well, because I think not many people actually sit on many chairs during their life. So it's quite interesting to hear your experience, especially bearing in mind that you're sitting in Hong Kong. So Asia is a very important market where actually in the last few months, we've seen things speeding up as well. There's been even think tanks being founded and consultancies that are going to work on ESG and trying to figure out how do we address the issues within the supply chain. So, which is, I guess, also something that the Mekong Club works on. We actually are very lucky that Elena has joined us, because one part of this whole story that we're trying to address, and what we also try to do with the paper, is the data question. So people argue that there's no data, or the data is all over the place, and we have these big issues. And as Julia mentioned, we really have problems. We're not naive about that, but I think a lot of these things have changed in the last few years. So we would love to hear from you, Elena, in terms of what is happening in the data space. Are there changes, or are we still hopelessly lost? Thank you.
Thank you, Linda, and good morning, good afternoon, everyone. Thank you for having me on this panel and the conversation, as well as for the great work that we have been able to accomplish over the last year and more. A lot is changing, and I think it's probably worth mentioning that we at Refinitiv have been working with investors around their ESG needs for close to 2 decades. And the evolution we've seen during that time is phenomenal. I think that we spent too long time on doing the business case around ESG, but the business case is now clear and it's behind us. So the conversations are no longer, why should I care? The conversations are, how do I do it? And this is something that we've experienced really over the last 3 to 5 years. Then, of course, last year we experienced one of the worst social crises of our generation, and that puts a much bigger emphasis on the urgency with which our society has to mobilize and react to the social challenges that we're presented with, and the critical role that investors play. What that has translated into is really a rush from all directions, from both public and private sector, from all regions, for transparency and standardization. And I'm speaking broadly around ESG, but with a much greater focus on the S. To give you an example, in Europe, the European Commission and the Action Plan on Sustainable Finance focused in its initial mandate to work on climate change for obvious reasons. And around the EU taxonomy definition, the recommendations put forward on this regulation address climate change. But last year, I really shook all efforts and emphasized how important it is to not focus and zoom in one area at the expense of another area. And I've heard many member states talking about the interlinks between the two and how important it is to tackle them consistently and coherently, because we don't want to put the fire down in one side of our garden at the expense of setting it at the other side of our garden. And we're in either way on fire. So that needs to drive for greater transparency and standardization is well understood. And I think all of our participants today at the webinar have witnessed the numerous initiatives emerging around it in the last couple of years. But I think it's very important to go one level deeper, and I'll try to do that and just discuss all myths from a data and investor lens, as well as, if I may make a comment on Adam's point. I think it was an excellent one, and not having a normative or absolute standards around the S makes it quite challenging to assess impact, progress, monitor performance, and report on it. But this is true if we are to have an absolute assessment. So from an investor perspective, having a normative standard allows us to measure an asset against that industry accepted benchmark in an absolute term and know where this asset stays versus the industry benchmark. Is it on the desired trajectory? Is it underperforming? Is it overperforming? And it's an absolute true that with climate, we've accomplished that. With the Paris Agreement, we have a trajectory. We know what is our objective, by what time frames, and it is a lot more doable to set an absolute performance metric for any asset, whether that's a company, a project, a portfolio, a fund. That is doable. But we don't necessarily have that with many of the social metrics. However, what we can do is assess performance on a relative term. And this is what the industry has been doing for quite some time, successfully, I would argue, across many of the social dimensions. What I mean is that you now assess performance relative to a set of assets, a set of companies, a benchmark, a peer group of companies, depending again on the needs of an investor and the asset class that they're allocating to. So there are possibilities. And I think it's worth mentioning that we've seen many social products, financial products, being created and launched for quite some time successfully, which indicates a couple of things. I mean, firstly, it indicates that there is enough information to actually create, develop, maintain effective financial strategies that do not only have the positive social impact or do not only manage social risks, because we need to think about it from both perspectives. It's the opportunity, it's the positive impact that an investor might be looking for, or it might be perceived as a more risk mitigation, risk management strategy. And the other important lesson that we can learn from the fact that there are a lot of successful products is that they also deliver positive financial performance versus traditional benchmarks. So I think it's an important message that it is not necessary to pay for better social impact. So this kind of touches on some of the myths, but maybe I'll pause here in the interest of time and I can elaborate in other areas as we continue the conversation.
Fantastic. Thank you, Elena. I love the fact that you highlighted how interlinked we are and how you can't put the fire out in one garden because somewhere else you might cause a lot of damage. And also what we found during the process is many examples where the S and the E and the G are all very, very interlinked. So believing that you're doing a really good job on the G or the governance side or environmental side while neglecting the social side can actually backfire because they are very interconnected. It's also interesting to talk about resilience. So that is a new buzzword, I guess, in a post-COVID world. And I'm glad both Adam and you mentioned that, you know, things are changing also because we are hopefully by now slowly exiting a global pandemic. And that has showcased how badly we need to address these systemic social issues because we are facing two different problems. Systemically, it's environment, but also inequality, because that creates much more volatility politically and otherwise. So we need to figure out how to address both. And I think the social aspect is so important for both. I'd like to actually go back to Adam now. So the key issues around ESG there's been a lot of talk about all the problems, but we seem to be lagging solutions. So now in a post-COVID world where we've seen how important is the S, what do you think are the next steps that we should be all making? And also in terms of these big criticisms around ESG, do you have any thoughts on that? Because I mean, we all have heard 𝗔𝗺𝘃𝗀𝘁𝗿 saying that ESG doesn't work, Scientific Beta saying that, you know, honey, I shrank the ESG alpha, there isn't sufficient alpha. There's a lot of controversy around this, and I would love to hear your thoughts about this. Plus, I want to also remind everybody participating in the call, if you would like to ask any questions, please do so in the chat. We're monitoring the chat box, and we will definitely make.
Yeah, thanks very much, Linda. I mean, I think the first thing I'd highlight actually is that last year was a revolutionary year in many ways for the use of capital markets in financing social goods. You know, I'm sure many of you are familiar with this whole sort of segment of the bond market called green, social, and sustainability bonds. Last year, social bonds were the absolute outperformer. Issuance increased by 7-fold. That trend has continued into this year. And what we see now is that social bond issuance is nearly 40% of this broader GSS, green, social, and sustainability segment, whereas in the past it was always in single digits. So it's been a really sort of breakout time for fixed income instruments that are being applied to social purposes. And I think that is indicative. That's obviously a response to the pandemic, and a lot of the use of proceeds from those issuances were applied to pandemic related needs. But they were broader than that as well. You know, there's money going into social housing projects in Korea. There's money going into kind of unemployment schemes in France. You know, lending to low-income households in Latin America, and so on and so on. So I do think there's a lot of potential that has been shown over the last 18 months for finance to play its part in delivering on these sort of social needs and the SDGs that they relate to. I think coming back to the point about you know, about critics of the ESG phenomenon and, you know, how we respond to that. I mean, my sense with this actually is that, well, first of all, it's not doing any harm. You know, the inflows into ESG investment funds and ETFs continue to be at record highs. There's no sign of this actually doing any damage. And I actually think it's a very necessary and healthy process. You know, there's a huge amount of enthusiasm about all things ESG at the moment, some very bullish predictions. You know, I saw one of Refinitiv's competitors expects this to be 1/3 of all AUM by 2025, which is, you know, astonishing. ESG assets to be 1/3 of all assets under management by 2025. So with all this enthusiasm, I think there's a really important place for some criticism, some skepticism, you know, that interrogates the claims that are being made, that tests the claims that are being made. And I think that's how you build confidence and trust, basically, in this asset class over the long term. And of course, in the needs and purposes that it supports. And this is really why I think the white paper and, you know, the continuation of this work is so important, because you are beginning to build that transparency. You're showing that the data is available. You know, you will, I think, in time enable the development of greater standardization as well, and that's all going to contribute to greater trust in the ESG asset class more broadly, and I believe towards making it more easy to invest the social component. Which is, you know, in its early days at the moment. So, you know, I welcome those kind of interventions. I think they're healthy for the market.
Thank you so much, Adam. I completely agree with your point about healthy skepticism and questioning these things, because unless we question them, we can't move forward. So I think that's a very important point, where it's constructive criticism rather than just criticism, because we also need to point towards potential solutions, not only highlighting the problems, and then actually in some cases what we found, just prolonging the myths, because then it seems, oh, we're in such a bad place, we can't do anything better. Which actually brings me to back to Julia. During this process, I think we spoke to so many investors and activists, experts, academics, practitioners. And it was a very interesting time, and also trying to figure out, what do they think? Are there solutions? What more can be done? And I'd like to ask you, Julia, what were the most interesting things that came out of it? What can investors do? What can they do to actually create these solutions, and how that can be done, especially because you have a great network and you you've seen how these different parts link together and where maybe the connections and conversations are missing. Unmute, please.
Sorry. One thing that we learned, and there is a lot out there that can be used as a, not even a starting, as a second layer. So I wanted to get back on Adam's point on the rigor. So the criticism, I do think the dialogue and the debate right now is fundamental to get us to a solution. And, you know, as Elena was saying at the moment, on the climate, there's clear set goals, and on the S, we're not there. But it was the same, and it would be very hard to find sets for a set standard for the S, but that was the same on climate 10 years ago. And so I think the debate and the discussion needs to be continuous and propositive. And while we were doing the paper, and what we learned is that we have SASB, GRI, Refinitiv, and RepRisk. They already have some great data that you can start with. And GRI has just gone through a consultation to change their and integrated their human rights with the UN guiding principle. There's a lot moving and a lot of improvement, a lot of pressure. SASB has consulted with NGOs constantly to improve their S criteria. And I think Refinitiv as well works closely with NGOs constantly. And so my one big learn is how much is out there that NGOs are doing already that we can use, the sector, the financial sector can use to for their data. And there's one layer that like, one is as an asset owner, an asset manager, you can start from really looking at the current frameworks from UN Guiding Principle, OECD, ILO, there's the UN PFI, there is the World Bank. There's some out there that give you a good starting point on where to look at. And then you can go dig deeper and really look at NGOs like WikiRate that brings together comparable and accessible data, or Impact Measurement Project, who's bringing together 16 standard setters to look at their reporting and impact, or the work disclosure initiative done by Share Action, who really, it was an investor-led initiative looking at workforce and with a specific on race and gender. And or initiative like Refinitiv one, like the Measure Up initiative on racial equity, and looking how data and in looking at indicators for racial equity. So more and more they're building, and they're there, they've been working on it for years. So it's just a matter of putting them together. Another very important tool that I would suggest asset owners to use is also benchmarking. I think Elena mentioned earlier, there's benchmarking done by the private sector, but by NGO like the World Benching Alliance and the Know the Chain and the Ranking Rights and Digital Rights. Those are 3 benchmarking out there that work in collaboration with NGOs and corporate, I think are really solid. And there are more specific one on gender and LGBTQ rights that people, again, asset owner and asset managers can use to look and get data from company. The lastly is like joint alliances, joint group. I think the silos are really actually the problem, not the discussion or the negative input. Is the fact that you go to a group and they're working on their little thing and the other group is working on this other thing, but actually the Alliance for Human Rights is a great alliance of different stakeholders, or the Human Capital Management Coalition, or PRI itself. Is a fantastic place to learn and engage in conversation or on different projects.
Fantastic, thank you, Julia. I think I couldn't agree more with the fact that there is a lot of silo busting that's needed. So we've done the myths, now we maybe need to address the silos. It's also interesting point about being a lot more proactive. I think this is something that we've seen in a lot of investment community. It's this passive approach to these things. So it's I'm going to consume some sort of output or insight, but I'm not going to go and look for it. And I think that might need to also be changed, because if you're looking at competitive advantage, if you can do ESG better than others and you can lay that claim and base it on something, that might actually be quite a good idea, especially now that everybody talks about ESG and it's so important and it's growing. And I think for that, you also need to start caring a little bit more, and maybe improving the knowledge base will also improve the amount of attention that gets paid for it, because you all of a sudden realize maybe I should care a little bit more about what sits under my ESG funds. So I would like to actually ask Elena.
Linda, sorry,
sorry,
just because I think on this point, and as a dialogue, is that, like, I think that's why it's so important now, the dialogue, is that there is a momentum, and what Adam was saying is incredible, like on the 1/3 statistic. But it's because there is that momentum, we have the duty to ensure that the data and the indicator that we develop will really deliver the impact and the monitor that we wanted to deliver. And I do feel, but my sense is when we talk to people, a lot of people feel that duty of around, yes, there is now a time to like look at it. And again, yeah, I don't know what the other things, but I do think we're going in that direction.
Yes, I think the momentum is definitely there. But that's why I would like to actually now ask Elena about sitting from a data provider point of view. What I'm wondering is, what are you currently seeing from client demand, and how you're looking at your data points? Because there's been also a lot of criticism about data providers providing convenient data that, you know, is meaningless, or whatever other criticisms there have been. Because when we actually worked with you, it was fantastic seeing how you're developing new indicators, adding data points. So what is actually happening? Are you seeing more disclosures? What would actually help you as data providers? Because there's also a limit to what you can get done without proper disclosure and regulation. So it'd be very interesting to hear what kind of trends and movement you're seeing from the client side, also from data availability side, and is also new technology finally starting to play any kind of role? Because that has been another very popular topic of discussion. Will new technology change the data landscape?
Yeah, a lot of change going on for everyone, clearly. And I think that the focus of what's needed from our perspective is absolutely at the right place. And this is common standards and definitions and mandatory disclosure requirements across all E, S, and G, rather than just an element of E or E. So I think that work is happening at the right place. But I also want to emphasize a very important key point of our working group mission, which is important to double down on, which is, as you mentioned, the expectation is that a lot of assets are going to reallocate to more sustainable investment solutions and products in the short term, in the next couple of years. And for that to happen, we really are moving beyond the point of just the top of the iceberg, or the cherry on the ice cream. Those very advanced investors and users that have been getting their hands dirty and tackling ESG for a very long time. This group of investors have to expand very quickly to the mainstream investment community. And for this expansion to happen, the industry needs to be enabled to start the journey. It's a journey for everyone. And the first step is usually the hardest. But once they embark on this first step and embark on the journey, the benefits are so obvious that the next steps naturally follow on. And I think a lot of it has to do with education and skills. And that's why the first step is so difficult. And there are a series of excuses that the industry has been relying on and quoting them as facts, which we try to demystify and explain why they're not facts anymore, why the landscape has changed and improved. Really, investors have to start looking within their own house and closing some of the skill set gaps that they may have to enable them to take that first step. Because to begin the journey, you have already quite a lot at your disposal, whether it's data, whether it's focusing on simpler issues of the S spectrum. It's important not to overgeneralize and say, well, it's too difficult to start. The start doesn't need to be perfect. It doesn't need to take you to the end goal. And it's important to break the problem into small pieces. Identify the ones that align more naturally with your individual investment philosophy, with your firm purpose. And I believe all firms have a purpose. They just have been really bad at communicating it or making it a positive purpose. And ensuring that this first step is a success for your individual organization. There is a lot of different nuances when it comes to ESG and S specifically, and there is a lot of learning that needs to happen. That's why there is a sea of opportunities and innovation that is unfolding and happening as we speak. And I think that kind of making it appealing to the broader marketplace is really what we try to tackle as a working group. And I think we achieved that primary objective quite effectively.
Thank you, Elena. Yes, we hope that we broke down a little bit of the complexity to energize the investment community to start thinking about this. And I couldn't agree more with the lack of particular skill sets. So if you have a head of sustainability, usually they will come from the environmental side with much more experience in that. So we need to close that skills gap also on the social criteria and how to actually address this within the strategy and portfolio construction and things like that. So I'm going to go back to Adam to ask your thoughts about how do you cut through the noise? So as we just discussed, it is a very noisy landscape, and I wonder if there's any particular interesting cases that you can bring to our attention. And also I want to remind the audience that we are still accepting questions. If you have anything to ask, please don't be afraid to type it in, or we can even potentially give you floor. There we go. We have one question, so we're going to address that as well in the next round. So we're still going to start with you, Adam, so that you can reflect on Elena's and Julia's points and tell us about some positive examples from your work. So Paul Rogers is saying that ESG focuses on measuring, quantifying, and mitigating financial risk to investors. So is it finally time to pivot this information to better communicate this to consumers, translating the investment in ESG into a return on sustainable investment at a product level? So this may be, according to Paul, this may be more likely to create this at a consumer level with present real information to drive sales and growth of business. So it's looking at the link between the investment and real economy, which I think is sometimes maybe missing in terms of also communication, in terms of how does ESG actually link to real economy outcomes. So hopefully with more disclosure, we're going to start getting there, but let's see. So I'd love to hear your thoughts, Adam.
Yeah, sure. Well, I mean, to talk about, to address your point about cutting through the noise first, I agree with Elena completely. Every organization, I mean, this isn't just about cutting through the noise on ESG. This is generally, it's about finding authentic voice. You know, it's about reflecting purpose. And it's about talking about what you actually do and are passionate about and is central to your business. I think the risk with ESG and the way that organizations sometimes try to communicate it is that they can try and play it a bit safe and be very generic, and you know, and then you're right, it's very undifferentiated. Whereas if you actually focus on, you know, your unique perspective on this, your unique angle on this, and you speak with an authentic voice, then you know, you have something interesting to say and people will pay attention. I'll be very quick here, but to give you one sort of brief example, you know, we've been very privileged to work with an organization that represents the securities lending industry here in Asia. This is a relatively unknown part of financial markets, and I won't bore you too much with it. But in essence, you know, they represent the market in which investors' shares that they are holding are kind of lent out when they're used for a variety of purposes, very often actually to cover short positions. They realized, you know, several years ago now that ESG was very relevant to their membership, because, you know, as people applied ESG to their portfolio, they were also starting to think about ESG in relation to what they do when they lend out the stocks and bonds that they hold, you know, particularly when it came to things like voting in AGMs or the kinds of collateral you would accept and so on and so forth. And so they did a very dedicated long-term piece of work, consultation on this process, survey, work to develop a framework for their particular industry. And it made a big impact and a big impression because it was really them. You know, they were talking about how ESG related to their field, and it was authentic. So it's just one quick example. I think to the point that that was raised about, you know, ESG being something of a financial risk prism for institutions. That is true, but in that respect, it's just the converse side of the broader sustainability agenda for the wider economy. So I think, you know, my sense is that your successes in ESG risk management and embracing ESG principles in your business that you communicate to your investors as a company are also, or should also be, achievements that you can communicate to consumers that will positively differentiate you with them, just as they positively differentiate you with investors. Yes, the language is different, the channels may be different, but it's ultimately the same game.
Thank you, Adam. That's extremely interesting. I love that approach. I also love your point about staying authentic and finding that authentic voice. And I think what you've just said completely links also to the change in terms of demographics. I think with the rise of millennials and people who are more aware, I think we might also see some different pressures in the markets, both from asset owners, but also from consumers. So, so I think that's absolutely fantastic. We also have one more question. So I'm just going to pop it in now, and then of course Ellen and Julia can reflect both on the previous question and on the new one. So Aoife McCarthy is asking about essentially about a normative standard and about what this normative standard would look like to show competitive advantage, because currently we don't have such a thing. And Aoife's question is, because it's not the case, what have we discovered investors look for when they rate companies on their social activities and causes? And I think Elena knows this very well, what they're looking for. From what I saw, there has been still a lot of these issues are driven by scandal or some sort of topical issue, Black Lives Matter, Me Too movements. So usually they're quite reactive. But I'd love to hear your thoughts, Elena, in terms of what do you think? What are the investors looking when they're trying to evaluate these companies and social performance?
Yes, that's right. And there are a variety of investment approaches that we've seen used by the industry, not uniquely for tackling social, but really across the ESG umbrella. The ones most frequently seen are really investors would either look at momentum or really searching for the direction of travel of businesses on social issues. So you don't have an absolute benchmark, but what you can already do is check and monitor, are companies improving their performance? Are they reducing the harm that they're causing, or the benefits that they are creating, the positive impact that they're creating? So it's that change in direction which is already doable by investors. As well as risk management. Risk management is probably the easiest one for investors to engage with and understand. And it's about minimizing the risk of allocating capital without pricing that risk properly in where social scandal developments are likely to occur and have very significant negative impact on the share price of stocks, for example. So that can be done either through screening controversies and the track record of companies and their involvement in such social scandals, or other types of channels that raise the flag on violations and negative implications of businesses and activities when it comes to social considerations. And of course, we do see many investors kind of engaging with the companies that they invest in to overcome and help them solve for the risks that they uncover. So it is not only about, well, do I invest or divest, or how do I price assets? It's about how do I work with companies to help them create additional value for me as their shareholder. I think it's a very powerful investment approach that many institutional investors have adopted, not in isolation. They're usually done in combination with some other strategies to then drive that positive corporate behavioral change that I think is so important. That's a great question.
Thank you, Elena. And it's a great answer because it's very interesting to hear what's happening now, because I'm sure that there's going to be tweaks and different advancements in this space as people discover that we maybe shift not only looking at the risk, but we also start looking at the opportunity. And I think more and more people are trying to figure out that within the resilience space. We actually have had a couple of more questions, which I think are very well geared also towards Julia's expertise in trying to link different continents and experts and different constituencies in creating that global dialogue. So Julian is asking that, well, actually making a point that while ESG is a big conversation in the developed economies, especially in Western Europe and increasingly so in the US, however, Central Eastern Europe and some other regions are really struggling. It's not a priority in a sense that people are still see this as maybe not that useful for improving their profitability or for improving their returns. So what can we do to actually improve that? How can we actually grow a bigger constituency of people who are believing in this and who are owning the process also in regions where this might be lagging? And Mimi Wu from Raise Partners is saying that in an emerging market like Vietnam, with many social and environmental challenges, it's almost impossible to draw a clear line between the E and S impact of an investment. So, and it's very interesting that Mimi is arguing that actually the measurement of this intersection between E and S should be standard, but is that something that investors are looking at? And are the existing frameworks that measure this overlapping? And I have to say that sadly, no. Usually you have environmental or social experts. There's usually very little intersection currently, but I think that's changing. But anyway, I'll give the floor to Julia now to talk us through what could be good ideas to link skeptics and converts.
Can I say, Elena, on the investor and the link, I don't know, do you have an answer to that on the S&D before I dig into the other question? Like Linda saying no. Do you agree, or maybe you have a?
I would agree as well as disagree. And I say that because indeed many of the expertise and many of the initiatives tend to focus on one or the other, not both. However, at the same time, what we're hearing from a number of customer segments, including asset owners, is that it is not acceptable for them to have a lens that's only E-focused and knowingly avoid understanding and measuring the S risks. So they are looking for a holistic ESG lens, which they can apply to their portfolios, investment universes, and have that long-term confidence that they're going to be able to fulfill their fiduciary duties. So there's definitely a market demand and acknowledgement that they're very much interlinked, and they present material financial risks as well as opportunities for investments, and they have to be looked together. But in terms of solutions that they have at their disposal, they're still somewhat siloed. So I guess it's going back to the point we made previously. There are a number of silos we ought to break next to move the dialogue forward.
I love that. I need to, like, I think on this one, if I can add, there's always the sense, I think there's not there. I agree with Elena and Linda, but I feel the debate is growing. And I think one of the studies that we looked at is the Business and Human Rights Center study on sustainable industry, and how they found out that there's so many human rights abuses within those industry. And so the point is here again, the sense of duty. We're building the ESG. We're putting all this effort in looking at the E, the S, and the G, and the criterion shifting corporate behavior. The last thing we want us to find in is that we change the corporate behavior, we build sustainable business, environmental business, and then we still have the same problem of abuses on labor rights and inequality and diversity and inclusion. And I think the foundation is working more and more, looking more and more, both at climate and inequality and the intersection, looking at just transition and ensuring there is a just transition. And I do think it's something we're all moving in that direction. There's a lot of organization out there, they're doing that, and happy to put you in contact, but we're not there into measure and framework, but we talk to Fund for the Future or Loudest. There's a lot of organizations who are looking at that and ensuring there's a just transition. The thing about the skeptic and the regions, there's two things. One, I hope one of the hope of the paper was to go to use it with the skeptics, and hopefully it's not regionalized, but if we want to regionalize it, we're in, especially in Eastern Europe, there's so many interesting happening. But the second bit I would say is sorry, this is more on the legal side, and I'm not a lawyer, but White & Case created an annex with all the legal changes that are happening around the world. And it's not only in Europe, in the US, it's happening across. And what is going to happen in Europe will have an incredible impact across the world in terms of company reporting. So I think for the skeptic, I would say engage in the conversation now, or it will be too late. And if in markets like where there are skeptics at the government level or also at the investor levels, not engaging in the conversation, even if it's happening at the European and US level, will mean that we will get it, like European and the US will get it wrong, because they wouldn't take into consideration regions like Eastern Europe that are going to be key for the implementation of it. So maybe I sound a bit of a broken record, but for me, conversation, discussion, learning is going to be key for this to be a success.
Thank you, Julia. Very good point. What we've seen in Central Eastern Europe and some other regions as well. Often there's a lot of pushing back, but not necessarily active engagement and trying to figure out how to actually improve what is already happening at the EU level, because whether we want it or not, the EU taxonomy is coming, and they are looking at social taxonomy, and the Biden administration is also looking at how to potentially figure out some sort of an alignment. And I think Julia's point is fantastic in a sense that, for example, ISFC is actually based in Central Eastern Europe. So you're already actively trying to engage different regions, also through us and through the paper, which hopefully some takeaways we will translate in local languages. It's also interesting to talk about the systemic level. I guess where the E and the S is very important is in terms of the systems level, where if you erode your consumer base and its ability to purchase, so its purchasing power, then effectively you potentially will start also destroying the environmental impact when people can't afford certain products that might be a little bit more expensive because they're pricing in the externalities of pollution or environmental damage. We only have a few minutes left, and I believe the Mekong Club wanted to share a couple of last slides just to show some information on how to link to their work and look at what they're doing and how to get in touch with them. I would like to still ask if anybody has any other question, pop it in. Otherwise, I would like to start wrapping up. And ideally, I would like to start with Adam. Sitting in Hong Kong, how do you see these regional debates? Are they very different, or is the world starting to talk at least about the same problems, or are we still very, very polarized? You're muted.
I think we are all heading in the same direction. You know, in the last 18 months, you've seen huge shifts from China, Japan, South Korea on climate, and I think that, you know, that just heralds an accelerating adoption of ESG in our part of the world. And we always say to clients here that, you know, ESG, and that includes the social component, obviously, is going to be the key to access to capital, to customers, and to colleagues, you know, to talent in the future. And that's as true in Asia as it is anywhere else. So I think this piece of work is a very important step forward, and I, you know, look forward to continuing the dialogue.
Thank you, Adam. Perfect. So, Elena, do you have any wrapping up final thoughts before we ask Julia as well?
Yes, very briefly, I think that my final thought and call for action would be that there are no wrong first steps. This space is so vast and so open right now. It's like a playground which everyone can come and play using their own toys. So don't be afraid. Take a step and start leading, because what soon will happen is that it will be there will be wrong inactions. Not only it's going to be wrong not to act on this agenda wherever you are, emerging markets, developed markets, but it will be very costly if it hasn't already hit your books. So I guess now is probably the last window of opportunity to engage with this topic around the S of ESG. And have the flexibility for free trial and error. Soon the errors will be costly.
Thank you so much, Elena. I agree. The errors are costly, and inaction potentially will be much, much costlier than action. And we do all learn by doing often. So, Julia, do you have any last remarks?
I mean, I love what Elena just said. Yes, soon try and error now are in part of the game. Soon they will be very costly. And as the foundation, we can say we are committed with the partners here, Mekong, 𝗂𝘃𝗃, Refinitiv, ISFC, and more, to continue breaking the silence. But we're also aiming to use our power with the media and the law to continue and building on this. So we're really excited, but we put the email. If you want to get in contact and want to get engaged in this work and want to hear more what we're trying to plan, do email the email on the chat.
Thank you so much.
And thank you to Mekong Club and everyone.
Yes, thank you to the Mekong Club for hosting us, for organizing everything. And thank you everyone for joining. We hope that this was good food for thought, and that going forward, people will feel more energized to proactively tackle these issues and try and come up with tangible solutions. We really think that this space is heating up, post-COVID especially, and that the time is really now to join the discussion and try to proactively influence it for better outcomes, both for the planet, but also very importantly for the people, so that we don't leave them behind. So thank you very much, everyone, and have a very successful week.